Hello, this is Mohammed Samie and I welcome you all to eAcademe from the platform of CA Educationist. Let's talk about direct taxes. Tax is one of the core sources of income for the government of any country that is utilized for running operations, ensuring public welfare, meeting infrastructural development targets, and providing for defense. There are primarily two types of taxes as levied by the tax levying authorities in every country. Number one, direct taxes. Number two, indirect taxes. We will be focusing on direct taxes in this video. The taxes that are directly paid by the tax-paying individual or entity to the tax levying authority are called the direct taxes. Another way of understanding these taxes is that these are those taxes that are imposed on someone's income, wealth, or property instead of some transaction. Unlike indirect taxes that are passed on to every person irrespective of their paying ability, direct taxes are charged according to the ability to pay premise, which means the higher the ability to pay, the higher the amount of tax. Let us now discuss three commonly prevalent direct taxes across the world. Number one, income tax. Incomes of individuals and all forms of businesses are taxed under income tax. An individual income tax is levied on the wages, salaries, or other forms of income an individual or household earns. Income taxes are levied at federal level and are progressive in nature. Progressive tax system is a system in which income tax rates increase as the taxpayer's income increases. It means the higher the income, the higher the tax rate. The income ranges against which the tax rates are progressively allocated for selection of relevant tax rates are called tax brackets or tax slabs. Once the taxable income is computed, the relevant tax bracket must be identified from the schedule of tax brackets and the corresponding tax rate must be selected for computation of tax liability. Tax brackets and corresponding tax rates are usually revised each year. However, it is not necessary as the federal government may resort to carry forward the previous year's tax brackets and rates to the next year. Like individuals, companies or business organizations are treated as separate legal entities, and their profits are also taxed separately. Like individual income tax, corporate income tax is levied by the federal and state governments on the business profits. Profits of business corporates are usually taxed at flat tax rates across the countries. Taxation of a partnership business varies from country to country. In some countries, incomes of partnerships are not taxed. Instead, all income received by a partnership must be shared between the partners. The partners are then taxed on the share of the profits they are allocated. However, in other countries, incomes of partnerships are taxed according to slab rates or a flat tax rate, whereas each partner's share is not taxed separately. Number two, capital gain tax. If a capital asset is sold at a price higher than the price it was acquired for, a capital gain arises. This capital gain is subjected to capital gains tax. What falls in the definition of capital assets and what items are exempt from this tax varies from country to country. Generally speaking, capital assets include securities, precious metals and possessions, and immovable property. Capital gains tax is not levied by all countries, and most countries have different capital gain tax rates for both individuals and businesses. The rates further differ in accordance with the holding period of capital asset before it is disposed of. If a capital asset is sold at a price lower than the price it was acquired for, a capital loss arises. Its treatment and adjustment rules also vary from country to country. Like income tax, capital gain tax is also levied by federal governments. Number 3. Real estate tax. Real estate tax is the annual tax that you pay on the assessed value of the immovable property you own. How the value of the property is assessed is highly subjective and varies across the countries. This tax applies to land and permanently attached structures like a home or building. The amount of real estate taxes you pay will depend on how much your immovable property is valued as well as the part of the country where it is located. For example, an immovable property located in a rural area is likely to be subjected to low real estate tax rate than a property located in a big city. This tax is usually charged by the local government of the municipality in which you own your property, and tax revenue from real estate often funds local resources like schools, police, parks, etc. In some countries, this tax is levied with the name of property tax. However, in other countries, real estate tax and property tax are considered as two different taxes, where real estate taxes cover immovable properties and property taxes cover movable properties like cars, boats, equipment, and furniture. Thank you for watching the video. For more videos, keep watching the series of eAcademe from the platform of CA Educationist by Mohammed Samie. For any queries, you may WhatsApp or email at the given contact details.